Simon Property Group, based in Indianapolis, is a retail REIT that is one of the largest owners of high-end malls, outlet centers, and lifestyle destinations in North America, Asia, and Europe. This is all according to Argus Research. As you can see here by the fast graphs, the orange line on this graph represents a FFO, funds from operation multiple, of 15 times FFO. The blue line, which is how the market has normally priced this stock, represents 14.46, almost virtually identical. The white line on this graph shows the dividend record of the company going back to 2003. And as you can see, coming out of the Great Recession, they did cut their dividend rather dramatically before they start raising it again until COVID. And then COVID came and they cut the dividend from $8.30 a share to $6, ultimately to $5.85. But now they've begun raising the dividend again, are expected to continue raising it going forward. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And this week I'm going to cover another real estate investment trust, one of the higher quality ones out there. It's A- rated Simon Property Group. And again, having an A rating on a REIT is very, very, high. Now, we have done a comprehensive research in conjunction with James Long that we will be adding here at the bottom of this video, so you can read our full thoughts on the company and research. What I'm going to do with this video is kind of go through Simon by the numbers, if you will, and show you some interesting aspects about why valuation can be so very, very important and beneficial in the long run. And Simon, we do consider to be very undervalued at this point. So let's go ahead and get into the video here, utilizing the FastGraphs Fundamentals Analyzer software tool and analyze out loud Simon Property Group by the numbers. So the first thing I want you to see here is the consistency of the growth of the company's funds from operations, which I like as the standard for measuring REITs. And as you can see, they had a couple of down years coming out of the Great Recession. They had a pretty significant down year, but it was a negative 24% growth during COVID, when, keep in mind, this was a 100-year event and they were literally forced to shut their business down. What I mean by that is this was not a function of mismanagement. This was a function of not being able to manage the business at all from a standpoint of doing business. Now, the company did manage to preserve cash flows by reducing the dividend, as I mentioned, and now the company's back into a kind of moving in towards a growth mode again, but very slow starting out here. And again, we cover a lot of the details of this company in the research report. But here's one thing I wanted to point out. I'm going to add the weekly closing stock prices to this graph now. And what I want you to notice about this graph is a lesson in valuation that I consider to be extremely important. Number one is, notice that on January 17th, 2003, Simon was trading at a price to FFO of 7.96, or approximately 8 times funds from operations. The company is currently trading at 8.88 times FFO, a very similar valuation. And that's very, very important because we're going to be measuring performance here in a minute. And we're going from measuring it from being undervalued in the beginning to being undervalued in the end. And this is in contrast to an overall stock market, i.e. the S&P 500, which still remains in many, many aspects overvalued or fully valued relative to Simon being dramatically undervalued. Okay, and there are some other aspects about valuation. I want you to notice that during COVID, we had what I call the flash crash, where the stock fell from $133 all the way down to, a low of $46.72. It now trades again at $105. And I want you to notice how cutting the dividend during those very, very, financially stressful times really stimulated a significant rise in the company's stock price. Buying Simon when it was trading at this low valuation would have resulted in an immediate rate of return of more than doubling your money from April of 2020 through November of 2021. But even considering if you bought the stock at its all-time low, and I'm obviously cherry picking, you would have still averaged over 28% per annum given today's undervaluation. So, low valuation is a great risk mitigator. But what I'd like to do now is I'd like to go very quickly and look at historical performance. And I want to remind you again, The stock was undervalued in the beginning. It's undervalued at the end. And there were 2 periods during this time. You could say 3, although this was really just a continuation of 1, where the company cut their dividend. So let's look at performance. And let's look at buying the stock in January of 2003. Let's look at investing $10,000. And let's look at it in comparison to the stock market, the S&P 500. Number one, I want you to notice that the company's yield on cost that year would have been 7.08%. Now that's important as a comparison because right now the yield is 6.98% or very close to 7%. So it's comparable to what I'm showing you here on the performance. And that yield over the years increased to where your yield on cost was over 47%. In other words, on a $10,000 investment in 2022, you'd have received $4,726 in dividends. That's, 47% of your original investment. And in its low point, after they cut the dividend, because it was $4,789 back in 2019 before they cut it, but you were still getting $3,814. Now, the total cumulative dividend was $47,913 over this time frame. Ladies and gentlemen, this is an income vehicle. And even with rising interest rates, you've got a vehicle here that's paying 7%, but has a history of growing that dividend historically, despite a couple of minor cuts. So this company gave you back almost half of your original investment over this time frame, compared to getting back $10,419 in the S&P versus $47,913, or 4 times your original investment back in terms of just dividend income over this time frame going back to 2003. This is what a really powerful income investment can do. And even at its discounted valuation, it still produced significantly more capital appreciation or total rate of return than the S&P 500, averaging 10.52% versus 9.8%. Now, what I'm doing here is I'm reinvesting the income in both the S&P 500 and Simon Property Group here. So, this is, you can see you got almost 8-fold your money and averaging over 10.5% over that 20-year period. Now, with fast graphs, you can also go in, and uncheck reinvest dividends. And I like to do this because this is how you compare it on kind of an apples to apples, not looking at what would have happened if you'd have just put $10,000 in and spent the dividend income. You can see your yield on cost still grew dramatically from 6.91%, which is approximately where we're at today, to over 21.63% by the end of 2022 and expected to be increased again. They just did increase their dividend by 15%, by the way. So what we're looking at here is a comparison where the company produced $29,000 in dividends versus $8,000 in the S&P. Capital appreciation underperformed the S&P, but because of that prodigious amount of income that the company threw out, you still outperformed the S&P by pretty close to a full percentage point. So the point of this is, and you're looking at rising interest rates today, an investment in a company like Simon Property Group, especially buying it at a very low valuation like you can buy it at today, gives you the opportunity to get income that's higher than you can get from most bonds. So if you're looking for income, if you're retired or whatever, this is a great place to look. But it also gives you the ability to see that income grow over time, which is critically important to you so that you can keep up with inflation in this inflationary environment. But you also now have a great opportunity for capital appreciation. As we talked about in the written portion that you can find below this video, if I look at Simon based on FFO growth of only 1.5% going forward for the next couple of years, rather modest growth, the margin of safety, because the company is so undervalued, is incredible. This would give us a fair value multiple of only 11.5 times earnings, but that would still give you an 18.66% rate of return. If the stock went back to a normal 15 times earnings, like it historically has, as I showed you here, you'd be looking at almost 30% a year. So you've got an income vehicle here that not only gives you a chance to give you higher income than you can get from bonds and even the stock market, but it also gives you an opportunity for high capital appreciation. And also notice on the price action of this REIT, during recessions, we had big collapses, but the recoveries were always very, very swift, as we have a, drop in valuation now. But look at all the times where the market has put a premium valuation on this stock. And whether that happens again in the future or not would be gravy. It would be, icing on the cake, if you will. But the point is, you've got a very high quality REIT trading at a very, very low valuation that gives you tremendous opportunities going forward. Now, I want to go into the financials a little bit. I'm going to go into fiscal fitness here. And I want to point something else out to you about this REIT. If you look at share buybacks, and I'm only looking at the last 10 years, contrary to a lot of REITs, this company has maintained their share count. They've had very, very little dilution. And normally REITs do dilution. But having said that, I think it's important to recognize that the company has also generated, growth and been investing in properties by leveraging their balance sheet. They've raised their debt. Their debt has increased rather significantly from about $20 billion in 2013, going back to 19 billion, up to about $28 billion. All right, now that's important because why would they be doing this? Well, in my opinion, the reason they did this was simply because the cost of debt was a lot more attractive to them than going in and raising equity like a lot of REITs did, because the problem is, if you look at the last 10 years that I showed you, they did have an opportunity to sell some equity at very high values. But, since 2017, the valuation has not been very high. So I don't think it was the best use of their capital to be issuing equity at that point in time. But let's look at debt. Now, one thing you can do with fast graphs, you can go into external links. And I showed you this last week. You go into the corporate website. You can go into investor services here. And then when you're looking at REITs, you want to go into the quarterly reports, which you can do right here. And then you want to go into supplemental information. Now, doing research on these stocks is critically important, and that's why we included the research report in conjunction with James Long, where you can see our full analysis of this company. But if you go into the supplemental reports, you've got an awful lot of information on the company that gives you information on their earnings guidance, the fact that they raised their dividend 15 cents or 8.8% year over year. It'll be payable June 30th, so the company just recently raised their dividend, and your best dividend is the one that was just been increased, as some people say. So you can go through here, but what's really neat about going into the supplementals on these companies, because the company is raising debt, you can go through here and go into the supplemental report, and you can get information on like their net income, net operating income growth, which is important. You can look at non-GAAP financial measures, but you can look at, all their properties and, get some detail on that. But what you can really do here, you can start looking at some of their debt covenants and, what their interest rates are. And the fact that their interest rates are still relatively low. And you can look at the number of years to maturity. So you can get a credit profile here to realize that this company generates the cash flows and the operating income to cover their debt. But you also can get a full summary of their indebtedness, the maturities, the interest rates on each of their debt, when their debt is maturing. And I'm not going to bore you through, for the timing of this video, to go through this, but I want you to know that you can have this kind of granular information, and knowledge is power. By going into there, you can learn a great deal about the company and its indebtedness. So we're looking at a company that, is very, very strong. Now, I also, and we mentioned this in the REIT part, this company has been very, very easy for analysts to analyze. And when they were estimating earnings 1 year in advance, they have an 83% success rate. And it was only during COVID that they really missed on the 1 year. And when you look at the 2 year, once again, we see that it was only during COVID that they actually, missed estimates. And once again, they had an 83% success rate, an 8% beat rate, but they only had an 8% miss rate in both of these times. And it was strictly COVID that caused them to miss. So what I'm telling you there, by looking at these analyst estimates here, you can be pretty confident that these estimates on 1 and 2 year future forecasts are pretty reasonable. And again, if you only look at an 11.5 multiple, you've got an 18% potential rate of return total over the next 2 or 3 years, as high as a 29 or call it a 30% rate of return over the next 2 or 3 years by investing in this company. Now, another thing I want to point out, and the reason we included the research report, is because you can go into this company, as I mentioned, and start looking at other research. For example, I subscribe to Zacks Investment. You can go into Zacks and get the full research report. And Simon Property, according to Zacks, is poised to benefit from its superior assets at premium locations. And you can also go through here and read the reasons why Zacks thinks it's a buy. You can also go in here and look at the reasons why they think it's a sell. You can likewise go looking at things like Morningstar, and you can look at, Morningstar rates at 4 stars currently, by the way, and they give it a fair value of $150, and it's trading at 105. There's that margin of safety factor, and their 5-star price is 105. And it's only just 98 cents above that, which brings them down to a 4-star. But they give, solid property net operating income growth offset by losses from retail investment is the headline, and you can read the full analysis, but you do have to pay for these kind of subscriptions. But you could also go into places like Seeking Alpha, okay, and, again, read various research reports and get some news on the company. The bottom line is we like this real estate investment trust very much at these levels. And I think the important message I want to get across here, if you can buy a REIT like this when it's undervalued, you put yourself in a real good position to generate superior returns, even if the company, ends up being undervalued at some time in the far-ass future. If you get lucky and can buy it at, where the market puts a premium valuation, you can make unbelievable amounts of rates of return. But the key is here, and I want to emphasize it, despite the fact that they've had to cut their dividend a couple of times, they immediately restated it, and the company has thrown off an enormous amount of income. So you can buy an investment now yielding, we'll call it 7%, 6.98%. It trades at a price to FFO under 9. It's an A- REIT. It does have debt, but it has the ability to amortize the debt, and you can go into that supplemental information and look at the debt. They have very low cost of debt, and they have very, very high return on assets and return on capital. So we can go once again into fiscal fitness here, and we can look at return on assets. Simon Property Group, the black line here represents its peers, okay, and it has almost double the return on assets of its industry peers. With the industry norm is 3%, they have 6.41. The return on equity is also very attractive. It's over 52% versus 4.67% from its norms. And then its return on invested capital, which I think is very important, is also very high at 8.83%. So I think this is a great time to be looking at this REIT. If you're looking at it for income, it really foots the bill very nicely because it can really turbocharge your portfolio right now. If you're a dividend investor living off your income like a retired investor, but because of the low valuation, it provides, I think, a very nice margin of safety right now. It also provides the opportunity for some, attractive capital appreciation above and beyond what, is available like through fixed income, even with interest rates rising. It's down a little bit today. I would take a hard look at Simon for long-term investment. And again, it's a long-term investment that I'm recommending. And again, I want to remind you, go to the bottom of this article and you can find a link taking you to our website on FastGraphs, and you can read our full research report that we've prepared for you. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Once again, thanking you for watching. I just think with the rising interest rates here, I did, covered several REITs last video, and I wanted to cover another one here. The low valuations of these REITs has really created an opportunity, I think, for long-term investors. In the short run, rising interest rates could hold these stocks down a little bit. But there's already been indication that the Fed is talking about, canceling the interest rate increases. That could be a turbocharger or a catalyst for these REITs to rise. I like this company very much for a long-term investment. I don't know how to pick the bottom, but I think you've got a very good margin of safety here. Do your own due diligence and research, as I've indicated. Read the research report that we provided. And I want to thank you guys for watching. If you like this video, ring the bell. Give me a like. Of course, subscribe to the channel and take a look at FastGraphs. What a powerful tool that makes it so easy to evaluate stocks. And by the way, we got some exciting features coming up in FastGraphs pretty soon. We're going to have, be providing investors or subscribers to our tool with the opportunity to have some pre-screened research candidates that look very attractive. So watch for that coming up just in the next couple of weeks. Thanks for watching. I'll talk to you guys again real soon.